Most companies pay dividends quarterly or even once or twice a year, but what if you could receive a steady flow of income every single month, like a paycheck? Yes, these type of monthly dividend stocks or ETFs do exist. So in this video, I'm breaking down the top 6 monthly paying ETFs that you want to have on your radar. They all share one thing in common: predictable income month after month with decent capital growth, so we don't fall into the dividend stock trap. I'm showing 6 today, but there are 11 more monthly dividend paying ETFs that I have blacklisted. If you want to get the full list, download the PDF link below after watching this video. Now, this isn't financial advice. I'm not telling you to buy these, but I'm here to give you the facts behind each fund, and you need to do the work to decide which one is right for you, if that's the right move at all. Let's get into it. Before I share the list, I want to clear up one misconception and share with you what criteria my list is based on. One thing for sure is that the list is not based on high dividend yield, and you shouldn't be fooled by it either. Why do I say that? Let's look at some ETFs that offer high dividend yields. The trailing 12-month yield of this ETF exceeds 6%. Despite a decent dividend yield, its share price has steadily fallen by 30% since its launch. And if we look at its annual total return, if we bought some shares since inception, the total return is only 3.5% per year, which includes 5.9% income return and negative 2.5% capital loss. Would you put your money into this investment that offers you slightly higher than a high yield savings account with 5% interest while losing your capital? The answer is no. This is the Global X Super Dividend ETF, DIV, which is traded on the New York Stock Exchange. How about this one? The TTM dividend yield is 10.5% and its annualized income return cannot be lower than 10%, can it? Its income return since inception is only 2.5% per year, and sadly, its capital return is negative 4.98%, bringing the total return of negative 2.47% per year. I think it's fair to say that we all should avoid this investment. You might be wondering, but the trailing 12 months dividend yield is so attractive. What went wrong? The problem is how we calculate the dividend yield. To work out the TTM dividend yield, we add the total dividends per share over the past 4 quarters and divide by the current share price. From a mathematical point of view, the higher dividend payout per share can increase the dividend yield, but a lower share price would also inflate the dividend yield. In other words, with everything else being equal, a high dividend yield might result from a falling share price. For this ETF, which by the way is Global X Super Dividend ETF, ticker SDIV, traded on New York Stock Exchange ARCA, shows exactly this pitfall. The skyrocketed dividend yield was due to the falling share price. Even if you would never sell the investment hypothetically and let the paper loss be there, the income return of 2.51% per year is not even as good as a term deposit. So rather than chasing headline yields that spike when share prices plunge, I measured each monthly dividend paying ETF's income and growth over time. First, I looked for funds that had delivered at least an 8% annualized total return since inception. I then confirmed that each has produced a minimum of 3% annualized income return, ensuring a reliable monthly payout. Finally, I required that their share prices have not lost ground and that they have at least a 2% annualized capital gain. How would I have done that if I had ignored the dividend yields? I asked my portfolio tracker, Navexa, to lend me the hand as it can track the real-time ETF share prices in terms of investment. I only believe in the real-time data. First, I created each candidate's monthly dividend-paying ETF, and 17 of them hypothetically invested $10,000 since their inception dates. The app shows me the annualized capital, income, and total returns. If you want the same portfolio tracker I use, feel free to use my link to get a 25% discount on an annual subscription on top of their promotional prices. Fund managers typically tap 3 primary sources to achieve monthly distributions. Many hold stocks of established companies, particularly in sectors like financials, utilities, consumer staples, industrials, and sometimes REITs, which are real estate investment trusts. This is the most organic way if the fund manager is experienced using quantitative data and fundamental analysis. Others allocate part of their portfolio to bonds or loans, collecting government or corporate debt coupon payments. Finally, some funds employ cover call strategies, selling options on stocks that they own to earn additional premium income. This way, the fund managers earn extra premium as income, whether the options are exercised or not. If it's exercised, the fund would also earn profit if the strike price is higher than the stock cost base, which on the flip side means the fund is giving up the potential upside gain at a later stage. If you want to know the nitty-gritty of how covered call ETFs work, you can watch this video after watching this one. Often you'll see a blend of these approaches as managers strive to balance yield, risk, and capital growth. Alright, with those out of the way, let's get on to the list. Sitting in the 6th spot is JP Morgan Equity Premium Income ETF, ticker JEPI. This fund was launched in 2020 with a 0.35% modest expense ratio. Currently, it has $40 billion in assets under management. It has generated approximately 97% per year in income and another 2.3% in capital gains, for a near 12% total return. JEPI acquires data-screened large-cap US stocks for dividends, then enhances yields through equity-linked notes and covered call selling. There are a couple income sources that these funds aims to get. The dividends from the physical common stocks that are bought based on a data science approach with fundamental research, and equity-linked notes that generate coupon payments with covered call premiums. An equity-linked note is a financial structure that combines a bond or note issued by a bank, which usually provides 100% protection or partial protection with an equity derivative, typically a covered call option. There's no need to dive into too many details here, but I believe that you should get to know the methodology by which the fund generates high income so that you can avoid certain risks that you are uncomfortable with, and this is your money anyway. So JEPI is a typical income-focused ETF. As a result, roughly 89% of JEPI's returns come from distribution, giving a hypothetical 100,000 position about $808 in dividends each month. Sitting on number 5 is Wisdom Tree US High Dividend Fund, ticker symbol DHS on New York Stock Exchange ARCA. This fund was established 14 years earlier than JEPI with $1.2 billion in assets under management. It achieves about 5% annual income return and close to 5% in price appreciation, combining for roughly a 9.8% total return. This fund adopts a totally different approach from the last one. Its 379 holdings are purely physical US stocks with no derivative products to seek additional income. The only source of income is from the dividends paid by the underlying companies. Given the annualized total return of a typical S&P 500 ETF SPY of 10.36%, this fund has done well since 2006 with almost equal return between capital growth and income. That steady mix translates to about $418 in monthly cash for every $100,000 invested, making it an appealing choice for those who prefer a straightforward equities-only approach. Coming up next is Invesco S&P 500 High Dividend Low Volatility ETF, ticker SPHD, traded on New York Stock Exchange ARCA. SPHD selectively holds 50 S&P 500 companies that have historically combined high dividend yields with low share price swings. Since inception in 2012, it has paid 6% annually in income while delivering about 6.7% in capital gains, for a total return approaching 13% per year. A bit different about this ETF is that the mid cap takes the biggest stake of 59% as of 12th of June 2025. From the companies it invests in, it may not have the highest dividend growth rate, but the source of the dividends is very organic and sustainable. It has been paying dividends in 12 consecutive years versus the average of 5 years of all ETFs. Overall, this is a well-balanced monthly dividend paying ETF with almost 50-50 return spread between income and capital growth. And this is the kind of ETF that pays dividend monthly and your capital is quietly growing in the background. When you're ready to sell, you won't get a nasty shock. For a 100,000 investment, SPHD's distributions work out to be around $575 per month. Moving on to the number 3 spot, Amplify CWP Enhanced Dividend Income ETF. Introduced in 2016 and charging 0.56%, it has produced about 6.3% per year in income and roughly 7% in capital gains, yielding around a 14% total annual return. Divo blends 24 high-quality dividend stocks with 10 covered call positions, targeting extra premium income on top of dividends. From the sector allocation point of view, financials takes the most significant stake, 27%, and tech takes 17%, and industrials take 15%. With every $100,000 invested, Divo distributes about $393 per month. Coming up in the second spot in SPDR, Dow Jones Industrial Average ETF Trust. This ETF has launched 5 years after the very first US ETF SPY. Dow Jones is a stock market index that tracks 30 large publicly owned blue chip companies trading on the New York Stock Exchange and Nasdaq. This widely watched benchmark index was created by Charles Dow in 1896 to serve as a proxy for the broader US economy. Although its dividend yield hovers near 1.5%, it still achieves about 3% per year in actual income and nearly 13% in capital gains for an impressive total of almost 16% annually. DIA has been around since 1998 and has been distributing dividends continuously for 26 years. Investors holding $100,000 of DIA can expect roughly $253 per month, paired with the robust growth of the large cap US stocks. At the top of my list sits DGRW, Wisdom Tree US Quality Dividend Growth Fund, which launched in 2013 and now manages $14 billion while charging only 0.28%. This fund specializes in companies that pay dividends and consistently increase them over time. Since its inception, DGRW has averaged about 3.7% per year in income and nearly 19% in price appreciation, delivering over 22% annually in total return. With more than 300 holdings led by tech giants like Microsoft and Apple, it offers a growth-oriented spin on dividend investing without using derivatives. Each $100,000 invested in this ETF will generate $311 each month, backed by more than a decade of consecutive monthly payouts. Looking back on the list, that they all pay dividends monthly and their total returns are shockingly good. However, some of them only buy high-quality dividend stocks and others use complex financial investment products. As individual investors, we need to know the pros and cons and any risks associated with the fund method. Finally, monthly paying dividend ETFs are great, but do they suit your current situation? In the US, if you hold a monthly payout ETF in a regular brokerage account, every dollar of dividend is treated as income and will be added to your tax bill for the year. In Australia, your ETF may already have paid 15% to the US government before it lands in your account. You then get a credit for that payment, but still must declare the remaining amount as income and pay tax on it at your own rate. Dividend ETFs are generally ideal for retirees on a relatively lower tax bracket or anyone needing a reliable cash flow each month, yet they may be less suited if you are chasing long-term growth or fall into a high tax bracket where the extra paperwork and annual tax hit would outweigh the convenience of steady payments. If you'd like me to analyze an ASX-listed monthly paying ETF, comment ASX Div ETF below. Which of these US ETFs do you hold or are you considering? Share your method. I read every message.